Good evening, ladies and gentlemen. Welcome to Ask Grit, episode number 53. Every single week or every other week, we catch up with industry experts or our own team members and discuss about questions we get asked from our own investors so that it can add some value to you. So today we have David Evans from Yellow Brick Road, who's a mortgage broker. Hey, David, how are you doing?
I'm very well, Nathan. There we go, life's lively. People are still buying things. People are still selling things. It's good.
That's right. All right, David, so as I was telling you, we do this gig every week or once in every 2 weeks. So we discuss about the questions we get asked on property investment and different stuff. So I thought of bringing on as well to talk about hot topics, which is the talk of the town right now is interest rates are rising and everyone thinks the sky is going to fall down.
Well, I don't think it is. I mean, interest rates have been not just low, they have been abnormally low. Right? You and I will never live just long enough to see the interest rates back at this rate again that we just had. It's been a once in a generation interest rate low, maybe historically. Typically, the Reserve Bank in Australia has been happy for interest rates to be between 4 and 5%. And if you look at the 3-year fixed rates I was just looking at before with Westpac right now, that's out to 5.07.
Right.
So that's what they believe the rate's going to be in 3 years' time. And that's their tea leaves experts. And they may be right, they may be wrong. But basically, if you look at what the RBA's wanted the rate to be, it's between that 4 and 5%.
Correct.
Also, interestingly, I think even when the rates were as low as under 2%, all the lenders were testing your ability to have a loan at 5.5%. So are interest rates rising? They're probably going back to normal is where they're going to, not going up. It's all a perspective. You just got to live long enough. That's all.
That's right. I mean, we haven't had an interest rate right for the past 10 or 11 years, and people were taking it for granted. And we simply cannot expect the interest rates to be below 2%.
Sure.
Sure. I mean, what does the Yellow Brick Road expect the interest rates will stop at? Do you think it'll go around 4 to 5% as we were talking about before?
Well, this is general advice only, not being specific. Yellow Brick Road don't predict interest rates, right? We just look back at history and see what history tells us. As I say, look, typically is that once they get to 6 to 7%, then governments start to panic. In terms of growth, I say that 4 to 5% is typically where the economy is moving along at a rate that both the government and the RBA wanted to move along at. I say we've had these rates that have been, historically abnormally low, call it what it will, that they have been just super, super low interest rates. And, if you're going to invest because you believe you need that rate, you're in the wrong game. Okay, you're in the wrong game. You need to be able to sustain a property, I say, probably aiming at around 4 or 5%, because that's what the banks have been doing when they've been lending you the money. You may not know that, but that's what they've been doing.
No, absolutely, you're spot on. I mean, when this happens, as you said, there's a panic in the market. 99% of the people will think this is not the time to invest. As a property investor, I mean, you got to be thinking long term, not the next 6 months. What are your thoughts, David? As a property investor, do you think they should be panicking or not really?
Well, you've heard me say this before. There are only 2 reasons to buy property, right? One is for lifestyle, because we only get one time on this earth. You go and live in the place you want to live in, have your family enjoy where you live. That's the reason to buy that property. The other reason to buy another property is for, asset wealth and accumulation, right? And again, that's not a short-term prospect, Typically, if again, you go back through history, if you hold on to a property for 7 years, it's hardly unlikely you're going to lose money if you've chosen well, right? You're going to make money. But if you're in buying property and think you're going to flip it in 1 or 2 years, just get down the casino and have a go down there. That's not the place you want to be. Mentally, you want to be thinking that 7 to 10 year mark where it's going to make that part of your plans. you've heard me say it's all about your journey in life. Where are you in life? Why are you investing in this property? Why are you buying this property? Why are you spending this money? What's the purpose? And once you define that purpose, then the decision becomes easy. It's just time is your friend after that, right? Time is your friend.
It all comes down to why. Why? What's your purpose? Why are you doing it? And then once you know the why, it's everything just stacks up very
exactly. Exactly.
All right. Another question from an investor. I'm a business owner and a property investor. I don't show much profits in the business. Thanks for being honest. Do I have any low doc finance options available?
Okay, a small business not showing much profits, highly unusual. You know, I say that every day, right? Every day out there, people come along with that. Okay, so yes, there are low doc options. You know, low doc options come with other conditions. One is you're certainly going to be paying a higher interest rate, but not crazy high. You know, not crazy high. So an example is you may get an interest rate that begins with a 3 as a, you know, if you're giving full doc, you're more likely to get an interest rate that starts with a 4 in the low doc environment. The other limitation that you need to understand is that you can't borrow as much. Typically, if you're given full doc, you're going to get a 90% loan. If you're going to low doc, the most you're going to get is an 80% loan.
Correct.
And you might be getting some sort of risk fee as well charged on top of that. So yeah, look, I help people do low doc loans all the time. They can be things from providing bank statements, providing your BAS, your GST statements.
Yeah. It
can be having your accountant sign off, just an accountant's declaration, a single piece of paper to the accountant saying that DAVIN can afford this loan. You know, I understand his books, and I understand he's taken out a loan for $500,000 with repayments of X and interest rates of X. I have no reason to believe that he can't do this, right?
Yeah.
So it can be just a declaration from your accountant. So if you are a small business person and you want to invest, make sure you have a very close relationship with your accountant. Right. Because it can be done. Look, I've done lots of low doc loans for small business people. Lots. Yeah. It's relatively simple.
There you go. That's the answer. And also, David, RBA states on their statement after last Tuesday that inflation will come down to 2 to 3% in 2023. So right now it's 5.1%. Do you think this is likely occurrence and the interest rate would stabilize in 2023?
Look, I say I'm not giving interest rates advice here, right? That's not what I'm about. And I'm certainly, it says mortgage broker up there. It doesn't say economist, right? About working out there. So inflation is a beast, you know. It's, again, you know, you look at what the RBA's target is. It is that 2 to 3%, you know, and that's where they want to go. They've managed that for a long, long time until recently. You know, it got too low, which is why interest rates came down. They certainly want to be back in that bracket. And, you know, Australia has managed to do that generally over the last 50 years. You look at it, most of the time they've managed that. So, yeah, you know, there's no reason to believe they won't get back in that if that's what they're aiming for, you know.
Yeah.
Yeah.
And also, I mean, we are at 5.1% right now. And if you look at right across the world, the US is around 8.5% inflation. UK is 9%. I mean, it's not as bad as people think it is. And don't you think?
Well, I think if you put inflation on one side and say, again, structurally, why are you investing the money in here and what are your expectations?
Yeah.
You know, if you're in the right space, I mean, the reason you're investing is hopefully to do better than inflation, right? That's the whole point of doing it, right? Because if you're not, so I think as long as you're looking to get yourself in the right space, whether it's property or other assets that you want to buy into or get advice about, you know, that's the way you should be thinking.
Yeah.
Inflation will come, inflation will go. It always does, right? If you're thinking about investments over the 7 to 10 year period, inflation is going to go up and down in that time frame. I can guarantee it for you, right? It will. So whatever it is in one particular year, in terms of your investment cycle, it's a pretty narrow thing to think about, you know.
That's right. And did you have any other questions from your clients in terms of property investment space, David?
Well, there's some other things that have been going on, particularly for our friend there in the small businesses themselves. We've been through a pretty rugged time with COVID and JobKeeper and all those other things that are going on. A number of the banks now are moving to say, in the past, they've wanted to see 2 years financials,
right,
and average them over that time. And obviously that's been covering the COVID period, which is, some businesses took hits. So
right,
there's quite a number of them now are just saying, we're going to do lending based on 1 year's financials only. So they're trying to get into that current period where hopefully your business has picked up since the COVID.
Yeah.
So people who are interested in lending, going out to loans and the self-employed, with some of the banks now, you only need to provide 1 year's financials, the current years, not 2 years, which may be affected by, I say, that COVID period out there, right? So that's been the big thing that's happened probably in the last 2 months.
Yeah.
A number of the banks have announced, both in the retail and the commercial space, they're looking at just, I'm sure they'll go back to 2 years in a little while and go, but right now they've got that level of understanding that only 1 year's financials is required for self-employed people. Okay.
That's great.
Yeah.
There's always an opportunity. Never miss a crisis.
Well, exactly. Before you do your financials with your accountants, you should always know what the answer is before you put them into the tax office, right? Always look forward to it. How much you're going to spend, that's a really important place. In fact, I've had clients come to me and we've done the thing and found out what the answer needed to be, and they've gone back to the accountant and say, can we achieve this result? And they've been able to do that, right? To working with their accountants, where their money's spent, what they write off that year, what they put into superannuation, whatever, right?
Yeah.
They've got that opportunity to look forward. So like everything else, it's about forward planning, right? It's about looking forward planning, right? Not stumbling into it. Yeah.
Right. And I'm just looking in on the stream. There's a question from one of the viewers. The question is, I'm just about to get into an investment property. Would you recommend going for a variable loan or a fixed loan with the current context?
Okay. My opinion is that generally I'm a fan of variable over fixed. Fixed, there's always an up and a down with fixed. All those people who took 1.99, a year ago, in a year's time, their rate's going to go from 1.99 to 4 or 5, right? It's going to kill them. The step is going to be giant, right? I think it's better to move with the times, is what I think, right?
Yeah.
Plus, fixed have some conditions on them. Okay. If you want to get out of fixed, especially when rates are going up, then usually there's a large penalty to pay. Okay.
Yeah.
So now, if I've lent you money at a certain rate and rates have gone down, why would I want to lend that money out for less money? As interest, right?
Yeah.
So personally, I'm a fan. If you think about this, we're still talking about rates that are on owner work, maybe on investments, sort of low threes, let's say around 3% on the investment rates, right?
Yeah. Okay.
So I've just told you that the Westpac rate for 3 years' time is over 5%. So that's a 2% rise.
Yeah.
If we're having quarter point rise, I know we just had a big one, but generally the bank's been doing 0.2. That's another 8 increases, right?
Yeah.
Do you think they're going to be another 8 increases? I don't know. But for me, variable gives you, especially as an investor, lets you stay light on your feet, lets you move things and change when you want to change.
Yeah. And it gives you that flexibility as well.
Without a doubt. Without a doubt. Yes.
All right. We typically stick to about 15-20 minutes, David. Thanks so much for joining me today.
No, I've really enjoyed it. Thanks for the questions. It's anybody wants to talk about anything out there, obviously they can contact me through DAVIN, who's go through there, and I'll be happy to help anybody out there. I've been doing this 12 years, and it's I've seen a few interest rates that go up and down. So, thanks for the opportunity.
Thanks, David.